Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Paul, welcome back to another episode of the AAA Storage Podcast. I'm so glad that you're here, as always. And what I love most, I've said this so many times in so many episodes, but what I love most about talking with you is you have been in the investing world, especially in real estate, in the last 30 or 40 years, doing lots of deals. You've been through a cycle or two, up, down, sideways, bunch of different cycles and different experiences and causes of the ups and the downs. I was reading on LinkedIn recently, our dear friend Paul Shannon shared some wisdom he has experienced through different cycles and different advice people have given him. He was on a panel recently sharing some ideas. And I thought, since last episode, we talked about the 2025 market outlook and how self-storage and real estate markets are performing, I thought it would be useful to hear from you, person to person, your wisdom and experiences of going through markets like these, whether it's up or down. We seem to be in a down period. We talked last episode is that the real estate market seems to be kind of bottoming here and hopeful, blue skies ahead. But, given this moment that we are in regarding the market now, what are some things you have learned as an investor over the years, over the decades that you've been doing this? And what kind of, wisdom or advice or, any other kind of commentary might you have, let's say, a high net worth investor seeking to invest in real estate, particularly self-storage? What would you share that maybe you wish you knew 30 or 40 years ago? Or what are some things that you've learned along the way, maybe the hard way? This is more of a relaxed episode of just hearing commentary and wisdom from Paul, because you've been doing this a long time.
Yeah, and I put a little bit of thought this morning into it, Brandon, and I always want to give people information that's valuable or helpful, and it kind of falls into different buckets. The first thing that I recommend, I have a really significant allocation within my own personal portfolio to alternative assets in general and real estate specifically. Probably highly unusual if you looked at my portfolio. But regardless, you need to have a plan. And you need to have a roadmap for how you're going to allocate capital within your portfolio. I think having that prevents you from over allocating when you get excited or the market gets frothy, and under allocating in other periods. So at the end of the day, I would say first sort of bucket of advice, and it's not really different than the stock market, which is be consistent over time. Dollar cost averaging is what they call it in stocks. And remember that market timing doesn't work.
Okay.
You'll never get it right.
Yeah.
You kind of hope to buy somewhere in the vicinity or the neighborhood of the bottom and sell somewhere in the neighborhood of the vicinity at the top, but it doesn't always work out like that. Just like stocks, if you hold them over time, they generally provide a solid return, sometimes better than others. So the next thought related to that is time and money. The more money you have, the more time you have. And I'm not talking about within your portfolio. If you look at the 08-09 debacle when things went to its knees in the real estate market, it was a true external sort of black swan event. The banks' financing locked up, real estate values plummeted. You couldn't refinance, you couldn't do anything. People who had staying power, number one, didn't lose the assets or the investments they had. And number two, as the bottom process began to reveal itself, they had liquidity and dry powder and got some amazing deals that created some real value over the 5, 6, 7 years, coming out of 2012, 11, 12, when the market turned. So, in more difficult markets, be smart about the use of leverage and the debt structures in the deals that you invest in. You also have to consider the timing of the real estate market. I try real hard not to make this necessarily about AAA storage, but if you're in a very difficult market and all the data in multifamily is telling you there's oversupply, rents are being driven down, and it's difficult to get traction with a new property, the projections in most multifamily deals, they anticipate lease up in a year to year and a half. You need to really consider what the market looks like and how difficult it is going to be to lease that project up, because if you don't, there's no cash flow. If there's no cash flow, you can't service the debt. If you can't service the debt, you either get a capital call or the lender forecloses. In self-storage, our lease-up period for a project is 4 years. I don't care what the market is today. It's going to be different in 4 years. So you may be behind the curve for a period of time in terms of the lease-up that was projected, but over that 4-year period, in almost every circumstance, you're going to see that property be able to perform at a level that will stabilize it and make the investment that you made work. So I think you have to consider so many different aspects. In every time in the market, you have to consider a range of things when you're doing your due diligence. You have to consider the cycle that the market is in, the sector that you're looking to invest in, who the sponsor is, what type of investment is it? Is it core or core plus, value add, development? And then the specific timing of the sector that you're invested in relative to the cycle. All of those things become important, and they become probably more important when things are more difficult. But anyway, a lot of rambling there, not a lot of good information.
That's always good. Location is a point of that. I think you were talking about what market are you in? Maybe that's a component of it. Would you say that whether you're in Texas, Florida, New York, or California, those are very different markets, but even more locally, are you in rural versus urban? And then what part of the urban, I mean, you guys talk about 5-mile radiuses and the kind of markets that you get involved in. Is it down to that level for an investor looking at properties?
I think that's where you have to depend on the sponsor, which is why choosing the right sponsor is important, because there's a level of detail and technical knowledge that as a passive investor, some are more active than others. Some really nerd out on the data and like to be super knowledgeable on that. Others really depend on the sponsor. I think that's another issue, is alignment with the sponsor. Does the sponsor have real skin in the game? Because the reality is there are sponsors out there who syndicate the next deal because that's what they do. In some cases, they need the fee income to keep their operations running. So they'll sort of develop or acquire into a market with a lot of danger signs. If they've got their own money at risk in a significant way, either as a guarantor on the debt or as equity in the deal, preferably both, then that's going to color their decisions. It's like the pilot in an airplane. I'm pretty sure that if there's a real problem with that airplane, he's not going to take off because he's going to be sitting on the front of it and he's going to be the first one to hit the ground at 600 miles an hour if it comes out of the sky. I think you want a sponsor in that same seat that's going to experience just as much pain and have to meet the same capital calls that you have to meet as an investor in the deal. I think having a sponsor with a real significant, meaningful commitment to invest alongside the limited partners in a deal is a really important thing to look at.
That's great. Okay. How do you think about liquidity when you're making investments, especially in a down market or in the kind of less certain waters that we find ourselves in now? How do you think about, like personally as an investor, thinking about liquidity and how you would invest and having that kind of dry powder? Is it like definitely have more in a period like this or less? Any kind of thoughts or parameters on that?
I think we're in a time now, we talked about this either last week or the week before on the podcast, where you're seeing a relatively short down cycle in the real estate markets. Multifamily, self-storage has had its own headwinds, but it's been a relatively short down cycle. Generally speaking, when you're going to make investments in what is a more challenged market, more liquidity is the right place to sit in, because the likelihood of getting a capital call, remember, time and money are related. The more money you have, the more time you have. Any real estate deal is ultimately more than likely going to be worth what you invested in it. How much more is always the question, and it really has to do with a lot of factors. But what you don't want to do is getting taken out of the game because you don't have liquidity to survive a down period. I told you the story. We owned a piece of land we bought in 2006, 17 acres in Concord, North Carolina, kind of between Charlotte and Concord, just down the road, a mile down the road from the largest regional mall in the state of North Carolina area. 2007, 8, 9 happened. And we had to sit on that property for 15 years. in order to get to a point where we could develop it, and it's now a very successful mixed-use project. The reality is, had we not had the liquidity and the staying power to stay in that deal, we would have lost a significant amount of money. Because if we had been forced to sell it or give it back to the bank, because originally we had some debt on the land, it would not have turned out well. However, we did have the staying power. We paid off the loan that we had on it, and we had the liquidity to pay the property taxes for a long period of time, and then we were able to develop it, and we came out of that pretty well.
Amazing. What other experiences have you had like that taught you these important lessons? If it was 10 years ago or 20 years ago or 30 years ago, maybe when you started investing significant capital in real estate, did you have a moment or a story where something happened or a deal went a particular way or a market went a particular way and you were like, I will never forget that?
Yeah.
You know, kind of these soul level lessons that you've learned.
Yeah. 1986. The Tax Reform Act. I got in this industry in 1981. And at that point in time, what was in vogue was very highly leveraged. We did a lot of multifamily, but we also did, retail shopping center type properties, office, hotels. But it was all very highly leveraged and structured to provide excessive tax write-offs. We were doing deals in 1983, 4, 5, where the investors were getting they were getting allocated losses that were twice their equity investment. And with a high net worth individual at that time that was close to the 50% tax bracket, the government was they were able to take dollars they would have paid in taxes and put them in a piece of real estate and roll the dice and hope they made some money. But in order to make those deals pencil with the kind of leverage they had on them, the projections were really unrealistic. And I look back how we thought about rent growth and net operating income growth. And there are two kinds of statistics, I guess, and the last one's damn lies. Turned out to be, damn lies in a sense. And so looking back on that period, when the Tax Reform Act was passed in 1986, it changed the landscape of the real estate world and sucked about 25% of the value out of every piece of multifamily real estate in the country, because it stripped out the tax benefits that were a component of what people were willing to pay for that type of real estate. And that combined with being grossly over-leveraged, deal after deal between 86 and 90, hit the wall and exploded, and the investors lost a lot of money. That was a lesson, because I was on the inside of that. I wasn't driving that market, but I was certainly putting together deals and a part of deals that had those same fatal flaws. And that's something that I'll never forget and I'll never do again.
And the lesson is watch your projections, watch your leverage. What's the moral of the story?
Invest tax benefits are a great side benefit, but it can never be the primary reason you make an investment. It's all about the economics. It's all about a solid asset that will move through more difficult cycles. Yes, it may be a little less valuable in the bottoming of a cycle, but again, over time, if you look at that piece of real estate, just like if you look at a blue chip stock or you look at the S&P over a 10-year period, it's going to provide a return. So invested in the right quality, the right structure, having the staying power to get through a cycle if you get caught in one, and thinking intermediate to long term, not short term.
It seems like a lot of this is coming back down to time. Do you have the time to stay in it? And then what is the projections over time? Obviously, there's time value of money, and it's central to finance. But
well, again, I'll sort of I'm not trying to do a commercial, but sometimes the time is, if the deals that you're in provide for capital calls, if additional capital is needed, then you become the source of that capital. Right. But it also has a lot to do with the sponsor and the sponsor alignment. In our funds, we don't have the right to call additional capital from our investors. And we have such strong alignment. We have such a significant investment as a limited partner in our deals, and we guarantee the debt. In the instances where we've had deals that were slower leasing up and had some degree of financial stress on them, we've loaned them millions of dollars to get them through that cycle. Now, that ultimately still affects investors' return, because it means that debt has to be repaid when the property is ultimately sold. And so it dilutes the return, not as much as equity would, but it does dilute the return a little bit. But as a sponsor, we have the staying power to get a deal or deals through a difficult market if we get caught short and don't have the capital we need to keep it on its feet until we can get to the other side of whatever the headwind is that's caused the problem. And so
I love that.
Invested in sponsors that are financially strong, that have good alignment with their investors is probably one of the most important things that you can do to avoid having really bad news come your way in the process of a down cycle.
I love that. One thing that Paul Shannon shared in one of his posts on LinkedIn, he was sharing that, in 2022, people were telling me this. And now in 2025, people are telling me this. I chose this direction. I chose that direction then. I'm glad I did. That kind of thing. I'm curious for you, is there something that you are hearing or you think is a common story or that you're seeing in headlines that you think maybe misaligned or not quite lining up with reality or what you expect the future? Do you see any major dislocation in a common story, what people are saying, what headlines read versus how you're interpreting things?
Well, yeah, my first comment would be about the herd mentality. I can remember in the early 2000s up to about 2006, actually, probably even 2007, you'd go to a cocktail party and there'd be 5 guys there that had quit their job and were flipping houses. That should have been a signal, right?
Yes.
That should have been a sign. When that's happening, run the other way. When everybody thinks multifamily is the place to invest, that means there's going to be a lot of capital flowing into multifamily, which means there's going to be a lot of new deals, which means you're creating your own problem 24 to 36 months down the road, right? Oversupply, pressure on rents, all the things that happen in the cycle. I said last time we talked about this, developers and sponsors sometimes aren't very smart. We become our own worst enemy, right? The conditions are good and capital's readily available, so we build too many apartments or self-storage facilities. And next thing you know, there's rate pressure and occupancy issues, and because we built too much. But the herd mentality is a very dangerous thing. If you ask the average person on the street, they would say multifamily's had a really tough time, and there's been, distress rates on the debt have gone through the roof, and there are foreclosures, and new developments have struggled to get off the ground. They were exactly right. They're only 18 months late. Now the data's swinging the other direction, which is, absorption of new units is up about 60 or 70% versus a year ago. New supply that's coming online's down by 47%. We're in the bottoming process that we talked about before. Now could be an excellent time, and Paul Shannon made the comment that if he listened to what everybody's saying now on multifamily, he'd likely miss the best opportunity, right? Again, You can't market time. You can't be exact. But if you're invested in the development of a new multifamily project today, that means it's not going to deliver into the market for another year or a year and a half, maybe 2 years. And if we're in the bottoming process, it's delivering right into a point in time when demand is going to be there, prices are going to be stabilized and increasing. You have to think about, I'm making the investment today, but when is this piece of real estate, what's the critical time frame for that piece of real estate? And the same thing applies to self-storage. Development activity has declined dramatically over the last 18 months or so, and there's forecasted to continue to decline into 2027. But because of the time it takes from the idea to dropping a self-storage facility on the ground and starting to lease it up, we're very comfortable developing in this environment, knowing we're going to be delivering projects in 26, 27, 28, even into 2030. The underlying demographic demand data is so consistent and strong that we're not swayed by the current market today, because we're looking at where we're going to be 5-6 years out when these properties deliver.
I'm hearing now is the time to invest. You want to be in, this is a pretty good time. Maybe not be exact, but it sounds like a good time.
It certainly could be viewed as self-serving, right? For a lot of this coming out of my mouth.
Right.
But the reality is, I absolutely agree with you. And I think guys like Paul Shannon agree with you. Warren Buffett said, when people are greedy, be fearful, and when people are fearful, be greedy. It's the herd mentality. It can be counterintuitive, but I absolutely believe that if you can really figure out where the masses are going, go the other direction.
He said in a interview recently that most people don't have the psychological state to be investing. And he kind of getting at that herd mentality. People are very fearful or they get very greedy or whatever, and you need to actually be more measured. If you want to be a successful investor, be more measured, have a plan, like you said at the beginning. Think through what you're doing. It reminds me of this book. There's a book,
sorry.
Robert Shiller, who's famous economist for the Case-Shiller Index. He has a book called Narrative Economics, and he talks about how there's so many stories that drive, market mania, which is a common thing. He unpacks what that really looks like in economic terms. It's really fascinating. But you hear these stories, but it may not be true. So be measured, have a plan, think through what you're investing in.
With the market volatility over the last month, particularly affected by tariffs, what you see happen is you see people selling stocks because of the uncertainty and their fear that, things may be going in the wrong direction. If you look carefully, you can find opportunities to buy companies or buy the stock in companies that aren't directly correlated or impacted by the tariff environment, but yet maybe down 15, 18, 19% from where they were 3 months ago because people just sold stocks.
Right.
So you're kind of swimming upstream, but you're doing it with a plan, which is if something's super exposed to the impact of tariffs and there's real uncertainty about their impact, then find the stocks that aren't, but have been affected by the general psychology of the market and driven down, because now you're getting value.
That's right.
And
it's one of the benefits of index investing and dollar cost averaging, like you're saying. As they sell all that index, all of the market goes down. Then there's actually non-efficient opportunities, which is great.
Yeah, exactly. And real estate doesn't move as quick, but it's very, very similar. And the market cycles are generally fairly short. And so, if you're trying to buy a house and flip it, you can get caught real easy, right? Because that's generally a fairly short-term transaction. Mm-hmm. But if you're investing in a solid multifamily project in a good market with a good sponsor that has staying power, and you're looking at a 5 to 8 year time horizon, what's happening today, less critical to me.
Yeah.
And I want to own real estate. Right. Like I said, I'm not over-allocated. It's my choice. It's what I've decided to do and have done for 40 years. A significant percentage of my net worth is invested in real estate in various forms.
That's right. You got skin in the game in this market.
Yeah. And so it's where I'm comfortable. Not everybody has that same, it's not for everybody, but I've done what I said at the beginning. I have been consistent over time. I've ignored market timing, and I've tried to find good opportunities that stand alone and stand out on their own, almost in any sort of current market context. And by doing that over time, I've made some pretty successful investments.
Benjamin Graham would be proud. I love that. Last question for you.
Okay.
Thinking about people that have influenced you, whether they're real estate investors, investors generally, could be economists, could be a friend. What is some of the best advice you've ever heard that has stuck with you? Somebody told you one time or explained something to you, and it's always stuck with you as being really sound advice through the years.
Wow. That's a hard one. Let me think about that one for a minute.
Next episode, maybe.
It wasn't a comment. It wasn't a piece of information. It was an attitude and an approach. The first job I ever had in the syndication industry was with a regional syndicator in North Carolina, and the chief legal counsel and chief operating officer was a guy named Joe Green. Joe went on to bigger and better things. He became the CFO and then the president of a publicly traded REIT, Winston Hotels. He then migrated into the student housing world and was super successful there. Joe didn't say this, but he did it. And his attitude was, if you work hard enough as a real estate professional and you think hard enough, you can make any deal work. In some markets it's easier than others, but if you are focused and committed to finding solutions to the short-term problems that can come up in a real estate environment and investment environment, you can find your way out of any deal and you can make it work, some better than others. Joe was a pretty extraordinary guy, one of the hardest working guys I've ever worked with, ever known. I think across his career, he may have made some decisions or investments that, whether they were misses on his part or things beyond his control, that didn't go well for a period of time. But I don't know across his whole career that he ever had a deal that failed, because he was determined to find a solution to make the economics of the deals that he put his name on work. And I don't know why that came to mind when you asked me that question, but it's an attitude. This sounds silly in business, but it's sort of a refuse to lose attitude.
That is the best thing you could have said. It's not a piece of advice. It's not an argument or a piece of information. It's a way of being. And to be successful in this world, in this asset class, you have to have a certain way of being about you, being determined, solutions oriented. And I know what, little I know of you, it seems like that's rubbed off on you in a lot of ways. I know you're a very hard worker, very diligent, and put a lot of time into finding good solutions and making deals work. It's a really admirable trait. So I appreciate that about you.
I learned it from a guy who was a mentor to me early in my career, has been a friend over the years, and has been successful. Joe has been involved in everything from, I don't know if he's ever done any self-storage, but he's done multifamily, hotels, student housing. He's crossed a lot of, areas in the real estate world. And so, yeah, I think that's, and again, when we're talking about passive investing versus doing things directly on your own, I think it's one of the things you want to look for in a sponsor. Is somebody is solution oriented, who's not going to hit the exit, not going to put on the parachute and jump out of the plane just because things get a little bumpy, because they do sometimes, right? It's the nature. I mean, they do in the stock market, they do in any investing environment. But again, at the end of the day, I think the reason I've been drawn to real estate is, number one, it just made sense to me from day one. Number two, it's a tangible asset. And if you have the ability to hold on to it long enough, you will never lose money. There are stocks that can become worthless, right? That's
right.
A zero value for a company is theoretically possible. It doesn't happen all that often with larger companies, but wild swings in value and the possibility of losing all of your investment is very real. In real estate, you own a tangible asset. So long as you have the staying power, it will always be worth something.
That's right. I love that. Well, I think that's a good place to end this episode. Yeah. Paul, I'm grateful for your way of being, your attitude about these things, because it's very helpful and very encouraging to me, as a younger, less experienced investor. But to hear from you and the way that you're thinking about things is just so encouraging and helpful. So I hope that listeners, even though some of it may sound self-serving, I know you to be a very genuine person. You're offering like very sound advice regardless of where you sit in the world. But I'm really grateful, and I know our listeners are too. So Paul, thank you, and we'll see you next episode.
Always fun, Brandon.
All right, man. See you later.